incremental analysis. Now, if we go back to the beginning when we were talking about relevant cash flows and we had differential cash flows and incremental cash flows, those incremental cash flows were the cash flows that were difference between doing something and essentially doing nothing. And so this idea of incremental analysis and doing something or doing nothing being our two choices is something that we can use to help make decisions from a capital budgeting perspective. And the most common example, and the one that you'd be most likely to have to know, has to do with deciding whether or not to replace an old asset with a newer asset. Because our choices are do nothing, continue to operate with the existing assets that we have, or the incremental cash flows would be connected to the new replacement asset. And so what we're doing in a situation like this is calculating the difference in the cash flows between doing nothing, keeping the old asset, or doing something and replacing that older asset. And so what we need to be doing in this situation is identify what the relevant cash flows are. And those are the cash flows that are different between keeping the old asset and getting the new asset. And so what we're going to do is we're going to kind of walk through this theoretically, and then we'll do it with an example where we have all of the numbers that go through this. So just kind of thinking about the situation where we have an old asset that we can keep, or we can buy a new asset. What are those relevant cash flows? Well, we have the after-tax salvage value of the old asset if we buy the new asset. Because if we buy the new asset, we'll be able to sell the old asset, and so that would be a cash flow connected to the decision to buy the new asset. And then kind of looking at the other end of the project, at the end of this new asset's life, it will have a salvage value. And so what is the after-tax salvage value of that new asset at the end of its useful life? We then also have this whole issue about depreciation, because the old asset might have some depreciable life left, and the new asset would have some depreciation connected to it. And so we need to have the difference between that depreciation tax yield for the new asset and the old asset if that old asset still would have been depreciated. Okay? That'll be a difference in the cash flows between the two options. And also if the old asset would have had a salvage value at the end of its life if not replaced, then the loss of that after-tax salvage value at the end of the old asset's life, because it would be sold now if the new asset is purchased. And then finally, any difference in any after-tax operating cash flows that would result from the new asset. Whether we're selling more and having more income, whether it's more efficient and we have reduced operating expenses, whatever that difference is in the operating cash flows connected to the old asset or the new asset. So what we're going to do is we're going to set up an example here and read all the information, and then we're going to go through these 5 cash flows and calculate what the relevant cash flows are for each of these kind of ones that we've identified here. So here's our information. A wannabe company is considering replacing an old manually controlled plastic extrusion machine with a computer controlled extrusion machine. Management estimates output could be increased and labor costs would be reduced with the new machine, so that before tax operating cash flow would increase by $90,000 per year. Wannabe's cost of capital is 12%. Its effective tax rate on operating income is 40%, and its capital gains tax rate is 30%. Well, here we have 2 different tax rates, and this doesn't make the question more difficult. It adds another step in the calculations, perhaps. What this means is, if we have any efficiencies, either increased revenue or decreased expenses, that increase in $90,000 per year, that's going to be taxed at a 40% tax rate. But the sale of the old asset, the sale of the new asset at the end, that's going to be taxed at a 30% tax rate. So the tax adjustment is still the same. It's just that we have 2 different tax rates, one for operating and one for capital gains. Okay, so just another item. It doesn't make it more difficult, just one more thing that we need to pay attention to. So the original cost of the existing machine was $80,000. We have installation costs, freight and insurance, the expected salvage value at the end of the useful life, and both are depreciated on the straight line method. The existing machine had a 5-year or a 10-year useful life. The new machine has a 5-year useful life. So those are the amounts that we have connected to each of these options. Continuing, the existing machine's expected useful life at the time of its purchase was 10 years, and it's been in service for 7 years. Okay, so it has 3 years left. It could be sold now for $5,000. However, if the older machine is kept, assume that it will not be sold at the end of its expected useful life, which would occur in year 3 of the incremental capital budgeting analysis. Instead, assume the old machine would continue to be used for current production through year 5 of the incremental capital budgeting analysis. Assume that at the end of year 5, the old machine could be sold for $500. All this means is we're going to continue to use the existing machine after its depreciation period has ended. It had a 10-year useful life when we purchased it. It's going to be depreciated over 10 years using the straight line method. But if we don't buy the new machine, we're going to continue to use that asset for the next 5 years, 2 years after its original useful life has ended, which is perfectly normal, perfectly reasonable, assuming the asset is still functional. So our question is simple. If the new machine is purchased, what will be the net present value of the new machine? And so what we have to do is go through these 5 cash flows and determine what is that incremental cash flow connected to the decision to purchase the new machine. So the first item, the after-tax salvage value of the old asset if and when the new asset is purchased. Okay, so if we purchase the new asset, it can be sold for $5,000 now. It's been in service for 7 years. Straight line depreciation has been $8,500 per year. So $59,500 has been depreciated. The original cost was $85,000 if we take into account all of the other costs in addition to the cost of the machine itself. So the tax basis is $25,500. So we would have a $20,500 loss and the 30% capital gain tax rate. Our savings due to the loss would be $6,150. So if we buy the new machine and we sell the old machine, the cash inflow from the old machine is $11,500. $5,000 cash that we got from it, and $6,150 in reduced taxes because of the capital loss that we had on the sale of that old asset. Okay? So that's our first cash flow. We've got $11,150. Now the second cash flow is the after-tax salvage value of the new asset at the end of its useful life. Okay? It can be sold for $10,000 at the end of its life in year 5. At that point, the tax basis will be 0, so we'll have a $10,000 gain. We have that 30% capital gain tax rate, pay $3,000 in taxes. So the after-tax cash received from the sale of the new asset at the end of year 5, $7,000. Okay? So that's what we've got so far. Now the third item is a little bit more involved. It's the difference between the depreciation tax yield for the new asset and the depreciation tax yield for the old asset. Okay? What that difference is going to be. So on the old machine, it would have been $8,500 per year for years 1, 2, and 3, and then nothing for years 4 and 5. Okay? The new machine is going to be $165,000 total cost, 5 years, $33,000 per year. So the difference in the depreciation the difference in the depreciation expense is $33,000 minus $8,500. So $24,500 in years 1, 2, and 3, and then $33,000 in year 4 and 5. And those differences in depreciation expense need to be multiplied by 40%. So the difference in the depreciation tax yield is $9,800 in years 1, 2, and 3, and then $13,200 in years 4 and 5. Now, the fourth difference that we need to look at, if the old asset would have had a salvage value at the end of its life if not replaced, the loss of that after-tax salvage value at the end of the old asset's life if it is sold now and the new asset is purchased. So what we're saying here is this. If we buy the new asset, we're selling the old asset right now. We already calculated the cash inflow from that. But if we sell the old asset right now, we don't get to sell it in 5 years, in 3 years, when it was over, when it ended its useful life. So we're giving up that future cash flow of selling the old asset in the future in exchange for selling the old asset now. So we need to calculate what it is we're giving up, because we're getting the cash from selling it now. But we are giving up the cash from selling it later. So the salvage value of the old machine, if it were kept and used and sold at the end of year 5, would be $500. would be fully depreciated for tax purposes, and so we would have to pay taxes on that $500 capital gain, 30% capital gain tax rate, $150 in taxes. So we have a $350 negative cash flow in year 5 because this is the cash we would not get in year 5 if the new machine is purchased. This is cash given up in year 5 if we purchase the new asset. Okay. Now this is offset quite a bit by the cash we get if we sell the old machine right now. But we're looking at the difference, and so we've got what we sell it for now and what we're giving up later. And finally, the easiest one really is that operating cash flow that we have each year. And we know what it is. It's $90,000 per year. We have to pay taxes on it of 40%, so that takes us down to $54,000 is our after-tax cash flow for that, and that's every year. Now, what we do next is we can put all of those amounts into our table. We've got our investment in year 0 of $165,000. We have the after-tax cash flow from the sale of the old machine. We then have the depreciation tax yield difference each of those years, $9,800 for the first 3 years and then $13,200. The operating cash flow, we have that lost $350 by not selling the old asset at the end. We have the $7,000 sale of the asset at the end. We get the net cash flows each year. We take the present value of each of those at 12% because that was our required return. And we get the discounted cash flows for each year individually. But we do have to take and add all of those together. We add all of those individual cash flows together. We get a net present value of $84,010. So, if wannabe company purchases the new machine, they're going to have an $84,010 net present value from that decision. So the net present value is going to increase by $84,010 if they purchase the new machine. Now, we could have done this another way. Instead of focusing on the differences between keeping the old asset and buying the new asset, we could have done what are the next 5 years' cash flows if we keep the old machine, and what are the 5-year cash flows if we buy the new machine, and compare those differences. Compare the total of the current machine, the total of the new machine, and compare the differences. We would get $84,010. But what we've done here is, instead of making 2 full calculations, we've made 1 full calculation by looking at the difference, those incremental cash flows from the decision of purchasing the new machine compared to the decision of not purchasing the new machine, or essentially doing nothing. So a lot of numbers here. This example is probably bigger than what you would have certainly in a multiple choice question. Maybe if you got something about this on a problem, it would get kind of close to this. But you're just identifying what are the different cash flows between the 2 options. And if you did get a big problem like this in one of the problems, the good news is you get points for everything you do correctly. So if you did this whole table of cash flows, you made this whole table here, and you got one of those numbers wrong, you miscalculated or you didn't take into account that what they give up by selling the machine now, the old machine now, instead of selling the old machine at the end, that $350, you'd get 95% of the points. Okay, so you get points in the problems for doing everything correctly. And so don't worry about 1 out of 20 numbers maybe being wrong. You've done absolutely brilliantly on that question. You're going to get 95% of the points, and that's a good result. Okay, so incremental analysis, making it or using it to make the decision about whether or not we should keep the old machine or whether or not we should invest in that new machine. And we've done the analysis here by looking at the cash flows that are different between the 2 options, those incremental cash flows, and using that to make our decision.